Hey, welcome back. It's Jason Walter here. Today, I have a special guest, Matt, the mortgage guy. He's a licensed loan officer here in California. Welcome, Matt. Thanks for joining us today.
Yeah, thanks for having me, Jason. It'd be great to chat with you today.
Absolutely. I would imagine we probably have a lot of viewers and subscribers that we share. But for those who don't know you, just briefly explain who you are.
Sure, Matt, the mortgage guy. My last name is not officially the mortgage guy. It's Matt Gouge, and
Oh, okay.
we're in the same market in Sacramento. I was a direct lender for 5 years, came over to the broker side, and have been on the wholesale side of mortgage for the last 3 years. And love what I do. Love educating folks, and that was the reason why I started doing YouTube. God, I think it's been 6 years. And so if you go to my channel, if you go to Matt the Mortgage Guy, there is a vast library, I think of 450 plus videos, where if you've got a mortgage question that you think I might have answered in the past, go into the search in YouTube and type in how do escrow accounts work, Matt the Mortgage Guy. Should I use the builder's lender, Matt the Mortgage Guy? Whatever your question is with Matt the Mortgage Guy, you might run across something that might be able to help you. So hopefully the some of those 100,000 views a month or so of people that are watching the videos, they're getting help no matter what part of the country they're in, right? Because me and you are in California, and I'm only licensed to lend in California, but my advice is good everywhere.
Well said. Well said. My territory is like a 30-minute drive of where I live, but we're all giving advice across the nation, right? What's going on in the housing market, what's going on with eviction moratoriums, forbearance, and whatnot. So yeah, thanks for joining us. I really appreciate it. So let's just dive right in. So obviously the housing market's absolutely insane right now. The prices in California have reached all-time record highs. By my dumb math, out of the last 6 months, we've reached record high home prices in California overall. And across the nation, home prices being broken in October, March, April, and potentially May, because the actual National Association of Realtors releases their new data tomorrow for May. So we'll have to see. So what are you actually seeing in your neck of the woods and with buyers you're working with?
Well, I'm working with buyers all over California, but the vast majority of them, Sacramento and surrounding. So Placer County, El Dorado County, Yolo County and whatnot. And while prices continue to go up, I do see, and this is my thing, is I'm an eternal optimist. So I'm on the buyer side. And so when buyers tell me like, when are things going to slow down? I want things to slow down. I do too. I want it to be easier for you as a buyer.
So do I.
I'm on your team, right?
Yeah.
And so I was talking to you offline a little bit about how I've got the bucket in my database that is fully pre-approved. They're ready to roll and they're submitting offers. And if I've got 85 or 90 folks who are in some stage, they're about to submit offers, they've submitted offers that haven't got accepted. Maybe they were looking 6 months ago and took a break, but they're, we've still got them in there. They're fully pre-approved. I've had more of those go into contract in the last 2 weeks than, much more than April and May. So in my head, without looking at stats or graphs, my hope is it's getting a little bit easier. Whether that is we see a slight tick up in inventory, whether that is some of the demand is coming down. I'm not one that sees any sort of housing correction on the horizon, but what I do see is maybe since real estate is seasonal and the summer market is not as hot as the spring market, hopefully there's a little less demand. And some of the buyers that were, active in the spring market are going on vacation, and them and their family are going to do other stuff during the summer that's not going to be searching for a new house. And if that happens at the same time as some more inventory comes in the market, then maybe instead of competing against 15 offers, you're competing against 4. And so that is like intuitively what I feel and what I hope. And I think sometimes I'm putting out there some hope for people who maybe have put in 3 or 4 offers. They're getting frustrated. They can't believe that their offer for $525 on something that was listed for $479 didn't get accepted. They waived their appraisal. They did everything they could. My hope is that in these next couple months, the combination of a few less people on the buy side and a few more listings on the list side is going to make it easier. And for clarification, for anybody who is going to tell me, oh, cool, I'll wait because in August I'll get a big break on price. I just don't see that happening, right? And that's, what's funny, Jason, is I wanted to bring this up to folks. I've talked to people and I've just asked them flat out when they've told, and people have told me the truth. They would rather wait and have an offer accepted because it's less competitive, even if that means paying more. So if I told you like, hey, in October, there might be less competition than there is today, it doesn't mean prices are going down because there's still enough demand to continue to push prices up. But if it's 2% more expensive, but the stuff you look at only has 3 or 4 offers versus 15, people, there's something psychologically about that where they don't want to, they don't want to deal with the competition. So it's
it's part of like with seeing a house online you absolutely love, right? You go to the house, it's absolutely beautiful. It's everything you want. You fall in love with it. You place an offer. You find out there's 15 other offers and your offer gets rejected. So I always tell people in real estate, when you're buying a house, it can be a roller coaster, right? You fall in love and then you don't get the house. You fall in love. So I bet it's probably that where they're sick of falling in love with the house they want to get. And then they're sick of getting outbid by other people. That's my guess.
Yeah. I guess that makes sense. It's just like, I don't want to deal with the emotional toll of getting super pumped over something, not having it happen. And so, have some, little better chance of buying in the future, even if it means at a slightly higher price.
Maybe so. Yeah. But I think you hit the nail on the head though, because people haven't really been traveling very much for over a year. Right. And so now we hit the summer months, kids are out of school, and then people have stimulus funds. They've been saving up because, some people, obviously other people have been adversely affected by this pandemic. But suddenly now they can travel again. And so I think that some people may be putting their plans on hold. And then what we typically see in our market, and this is across the nation really, is that housing inventory tends to increase during this time of year because of that. It would make sense if you see more offers being accepted. Maybe that's a reflection of maybe there's less buyers out there and more housing inventory.
Right. Yeah. And I think that there's still an imbalance. So people shouldn't, misconstrue that information where prices we're still going to see price appreciation, but it might be slightly less and it's going to be a little bit easier to buy in the next few months is the hope. And really, you've got a YouTube channel that you're getting hundreds of comments every single week from people across the nation. Same for me, where I want to get the feedback and hear like what's happening in your market. I hear people in Minnesota, in Florida, and Texas, similar type stuff. I'm seeing more houses in the neighborhood I'm looking at, so they're feeling it too. And I think that it's coming to where folks who have been on the sidelines and maybe they put in some offers, got frustrated. Hopefully these next few months are a little bit easier for them and they can get some offers accepted.
I hope so too. I mean, I'm actually really crossing my fingers for a long, long time that we'll have more of a balanced real estate market because as real estate agents, we represent buyers and sellers, right? So it can be a little bit easier to represent a seller right now, not so much for a buyer. And so I think there's this misconception out there that real estate agents and loan officers want home prices to go up forever. But it's simply not the case. It'd be great to have more of a balanced real estate market. So when we're representing our buyers, we're having a little bit easier time. There's more options out there for them.
Right. Yeah. And I own, some real estate and I'm rooting against 15% appreciation year over year, because although it would help my net worth by everything that I own going up in value, I just know it's not sustainable. It's just not healthy. So I'll take the 3 to 5% and just, that's a little bit more healthy. We could see wages keep up with home price appreciation and folks will have an easier time. We just need a million listings to hit. So if there's sellers out there that are thinking about selling, go ahead and help us all out. Just list your house for sale.
Yeah, really. We all need some help here. That's for sure. I think it's what you mentioned something earlier too. That's also important thing to note, that some people think that the housing crash just happens just like this. And I get comments all the time like, when is the housing market going to happen? If I knew, I would tell you, right? But there's so many things and factors involved that makes it nearly impossible to predict that. And then also it can take a long time, months. It doesn't happen overnight. Like the stock market can take 1,000 points in one day. Home prices don't decrease 10% in one day. So in my opinion, home prices can't go up forever. It's not sustainable. It's not normal to have home prices increase by 20+% year over year. And so I think we're probably going to see less and less home buyers who may be getting frustrated and then also maybe getting priced out as well. And that could potentially cause eventually the housing market to decrease. But of course, there's inventory and interest rates, and that's really kind of beyond our control. But yeah, what do you think the future of the housing market holds for us for the rest of the year going into 2022?
Yeah, I mean, I think in the short term, because of the supply demand imbalance, I'm pretty bullish on the housing market, and people that tell me that they want to wait, I advise against it. And
Mhm.
people always want you to make a prediction. So they always stick you to like, if you had to make a prediction, if you had to
I
make a
am not
bet.
asking, I'm not telling you to make a prediction right
Well, no,
now.
no,
I'm
no.
just
But I'm
giving you
saying
my, yeah.
I get that. So I've already done it.
Yeah.
It's already out in the universe. So I don't mind doing it. I see the slowdown, not meaning that we're going to go backwards, but we're just going to slow down from driving 120 miles an hour to 80, which if we saw 15% last year, and every market is kind of different, maybe we see 7 or 8% in 2021. I know the first half of the year is going to be higher than that. And so the second half of the year, if it slows down a little bit, we'll drag that number down. And
Mhm.
then in 2022, maybe we only see 3 or 4% appreciation, and 22 and 23 might look a little bit more flat. It would be healthy. It would be a good thing for the housing market. What I don't see is a big correction unless certain things happen. And I think that everybody is trying to point to one thing that is going to have this big effect. If rates go up, the market crashes. If tons of people foreclose, the market crashes. And really, it's more like,
Forbearance,
right.
moratoriums. Yeah.
Yeah, it's more likely to be a combination of things. And the thing that I look at and track, because I'm talking to people about their mortgages and their mortgage payments, is the affordability index, which when you look at the
Mhm.
home prices and the interest rates that are historically low, affordability isn't a big of an issue as people think. But I think it was Black Knight. Black Knight data has amazing data, and they
Oh, I
had
love
some.
Black Knight.
Yeah, and so I think it was either their April or May report where they showed the affordability index, and on top of that line where the affordability index is still like got a lot of room to run, right? But they showed like what happens at affordability index at 3.5%, at 4%, and at 4.5% interest rates. And so
Mhm.
if rates go up and all of a sudden we're dealing with an affordability index problem, which for in layman's terms, it's hard for people to afford a home
Yep.
at the average price, then that is something that could cause the housing market to slow down and correct 5-10%, right?
Mhm.
Because right now, $550,000 sounds super expensive for an entry level home in the Sacramento market. But
Yep.
then when you look at what the total payment is with a 2.875 interest rate, like, oh, wow, that's not terrible. Slap a 4.5% interest rate on a $600,000 house in a year from now. And then, that same couple that makes $130,000 combined that could afford 550 is going to be looking at a payment that's $600 a month more, whatever it is. Right. And
Mhm.
that's going to be an issue because right now
Yep.
there's enough people that can afford to buy where we could continue to see home price appreciation because demand is not going to slow down. Once
Yep.
people start falling off of that, I can afford houses to this amount, then we're going to see a natural correction in the housing market.
Yeah. And I think in areas where are more affordable, quote unquote, like Sacramento, that's close to like the Bay Area, people moving from New York City, people moving to Austin, Texas, Idaho, Utah, in my opinion, will have those markets are going to continue to go up for a little while because people, maybe they don't have to work at their offices anymore, even though some people are going to be asked to go back. I mean, there's people I've helped at moving from the Bay Area, have a studio apartment there in San Francisco, paying $4,000 a month. You can buy an amazing house in the Sacramento region or anywhere like in Austin, Texas, Idaho. And then oftentimes their housing payment actually goes down. So I think every market's different. But in general, I think it's pretty safe to assume that it's definitely a strong seller's market. We're starting to see some signs of slowdown. Is that seasonal or is that something that buyers are just kind of giving up? It's hard to say.
Right. Yeah. It's probably too early, and only time will tell. As much as people want an answer of like what's going to happen, I think
Yeah,
me and you both would admit, we shall see. We don't
yeah,
have any, firm data that's going to tell us, oh yeah, it's headed this way or it's going to do this, because nobody knows. And we also don't know. You do a great job of all the stats and all the data with forbearance and what's happening with those people coming out of forbearance. Are they going to foreclose? Because all that stuff affects the housing market. And
Yep.
I'd like to ask that question of you, because I haven't looked at it as often as I used to. But I know when I was looking at it, the people coming out of forbearance, those were performing. There wasn't as many people going into foreclosure as possible. So is it still trending that way, where like the number is going down, 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 and there's not a lot of delinquencies? Yeah.
I'm so glad you asked, Matt, the mortgage guy. So Black Knight reported, I haven't made a video about this yet, but Black Knight reports every Friday about new forbearance numbers. The MBA, the Mortgage Bankers Association, also reports that on a weekly basis as well. But I think we're down to less than 4% of all mortgages are in forbearance right now. The MBA is great because they post, what do people do actually when they exit forbearance? And approximately 50%, just over, have either just continued to pay their mortgage payments, even though they didn't have to, or they did a partial claim loan deferral, meaning they take the loan, the missed payments, just add to the back end of the loan. Doesn't change their mortgage payment at all, just increases the term of their loan, right? So that's the vast majority are doing that. Approximately 7.5% have either refied or sold their houses. And have obviously, I think it's 1.7% have either foreclosed, deed in lieu of foreclosure. But obviously with the foreclosure moratoriums, obviously that's going to be next to nil anyways.
Right.
But it just goes to show that the vast majority of the people are either just continue to make their monthly payments, even though they didn't have to, or they just did a loan deferral. And if you have a federally backed mortgage, you don't have to make a one-time lump sum payment when you exit forbearance. And that was the big thing early on, where people thought, oh gosh, how much was it? There was 4.5 million people that were in forbearance in May of 2020. Everyone's saying, oh, the housing market's going to crash. They're all going to get foreclosed on. But the fact remains, you still can enter into a forbearance right now if you have actually any federally backed mortgage right now. So yeah, we'll have to see what happens with that, but it doesn't appear that's going to be causing any foreclosure tsunami, because there's people entering now that can do a 12-month forbearance. There's people who entered in March of last year, it can do an 18-month forbearance plan. So yeah, I don't foresee any housing crash from the forbearances.
Right.
But what's your opinion on that?
Yeah, I mean, I think that we align on that. We can debunk that, whatever people are saying about, oh, we've got this many people in forbearance, this many people are going to foreclose. Like you said, vast majority of them are paying and never even missing a payment while they're in forbearance. And then if they do miss payments, they get out, they've got plenty of options. And their
home equity has increased in the meantime.
I was on the front lines last April and May saying, hey, listen, before you get into forbearance, make sure that you don't have to make a lump sum payment, because I was afraid for people, just like you said, where they said that if you have to make a $20,000 or a $40,000 lump sum payment and you haven't made your mortgage for a year, that's going to be hard to do. But besides all these options that servicers are giving folks, because the CFPB came out and said you have to give people options, you have to offer them a loan modification, you have to offer to put it on the back of the loan. My boots on the ground kind of insight from people I talk to is, I had a client jokingly tell me that forbearance is the new cash out refi. Because he goes, hey, if you want $30,000 for a project, go into forbearance. You don't pay a $2,500 payment for 12 months. There's your 30 grand. And the best part about it is there are no fees. There's when you do a cash out refinance, you might pay some fees. And
on top of that, they don't have to prove they have a financial hardship.
Right.
If you have a federally backed mortgage, you say, I attest the fact that I have a financial hardship because of COVID-19, indirectly or directly.
Yeah. And the other part too, where it's are they doing too much? We know we want them to do more than they did in 2008. We don't want to see a bunch of foreclosures, but maybe they've gone too much to the other side, because I've got clients that have called me and said, hey, I want some advice. I'm exiting forbearance. Here's what my servicer offered me. Here's what they've told me about. I've got clients who are getting their interest rates dropped, and then they're able to do a 40-year mortgage. And people always ask me, how do I qualify for that? Nothing. Just as easy as it was to click into forbearance, it's just that easy to have your servicer say, we'll offer you this on a loan modification. Okay, we'll send you the paperwork. We're going to do 3 months of a trial period. And then once you make those 3 payments, you enter into the official modification. But those folks are going from a 3.75 to a 3.125 and a 40-year loan. even with wrapping in what they've missed, they're lowering their payment by $500.
Wow.
And the interesting part for me is you always think about like, what are the long-term repercussions of this? Imagine you're in a house and you get that sort of smoking deal on a modification. It's gonna be hard for you to move.
Yes,
If
I
I
agree.
lower your payment by $500 and stretch your mortgage out 40 years, and then you're like, you know what? It'd be cool if me and my family moved to this part of town because of schools or because of whatever's on that other side of town. If a house that isn't even that much more expensive costs you an extra $900 a month because rates have gone up and you're not able to put it into a 40-year loan,
Yep.
you might just sit still. And we've already seen the stat I saw that I was really surprised by, but then not surprised to read it, was the turnover rate, where people used to move every 8 to 10 years. And now I think it's up to like 13 years. People are
Yeah.
just not moving as much. And that's
Right.
part of our inventory problem is we
For sure.
need people moving around so that houses can sell. So
Definitely true.
interesting.
I'm wondering about that because I haven't seen any stats about, because I know there's all these options, right? If you have a fairly back mortgage, you can do a loan mod, you can do a loan deferral, but I haven't seen any stats about, do they give you that option? Say, do you want the loan deferral? And they say no. Okay, well, here's a loan modification. Like there has to be some sort of like qualification, I would assume, but
I don't know. I
I'm
mean, the
left.
client that I talked to recently, where I kind of drilled in and was like, let me know what they asked of you and what questions you had to answer. And the client told me that they first gave him the options where it's like, if you want to make up these 12 months of payments and make a lump sum payment, or you want to spread it out over the next 12 months and make those. And neither one of those options are good for most people. They're like, I don't have $50,000 sitting in my back pocket. And so they opted for, which probably 95+%, I would imagine, opt for, just put it on the back. And so it's going to be a lump sum payment that's due when you refinance or due when you pay the loan off and sell. My client just kind of kept asking, well, what else is there? What can I do? My rate is higher than the average rate out there. I'm paying a 3.75. And my client said it was that easy, that an option that didn't exist at first when the servicer was talking to him, they said, well, we could actually, if you wanted to lower your rate, we could offer you a lower interest rate and a 40-year term through a loan modification. My client said, okay, what does that look like? Well, it's $500 less per month. And that was even wrapping in and paying off that what would have been put on the back of the loan. And so I would imagine, and here's the thing too, is I'm trying to get data from clients, what different servicers are doing. But I think from what I know from the last crash and loan modifications, it's kind of servicer by servicer. And different ones are going to do different things. I remember in 2010, I wasn't even in mortgage back then, but I had plenty of friends that were in the business. A lot of servicers weren't offering modifications and a lot of people were foreclosing, and something came out or something was pushed where they said, we're going to require servicers to modify a certain percentage of their portfolio because there was just too many foreclosures going on. Yep. And so then you started seeing more and more of these loan modifications. Well, now in 2021, they're getting way ahead of the problem and saying, like, we don't want to see any foreclosures. Just modify as many people as you can. And it was pretty clear terms or language from CFPB that said avoidable foreclosure. And here's how you do it. You offer loan modifications. You offer to, various different things to help consumers out, because foreclosures are, bad for the consumer. They're bad for the community. They're bad for all this. And so that's why, if we're talking about foreclosures and we're talking about that having an effect on the housing market, the government and the powers that be have made it real clear. We're going to avoid foreclosing by any means necessary.
No, I 100% agree with you. And I think it's going to be like the options that are available to you would depend by the questions you ask. So make sure you're informed about what your options really are. And then also the actual loan servicer itself. I had a client reach out to me a few months ago and said, hey, I'm really having a hard time. Been unemployed for a year. I felt so bad. I feel like I should have been reaching out to all my clients and telling them about forbearance and options they have. Any case, I told him about forbearance. Said, oh gosh, I didn't know that. I thought that I had to make a one-time lump sum payment once I exited, and he has an FHA loan. And then I told him, about forbearance. Told him to contact his loan servicer, find out about options. And when he told the loan servicer about doesn't have money in his bank account, he's unemployed, then they basically like read basically like a script, like just like their disclosures basically, and then asked him, "Okay, are you ready to make your mortgage payment?" He's like, "No, I called you because I want to enter into forbearance." And so I could just imagine with all the loan servicers out there, all the people that are having a hard time, how many people are getting misinformation, right? How many people are scared to let their loan servicers know that I don't have a job and they're worried about getting foreclosed on. And so I know that the CFP, what is it, the CFPB, right?
Yeah, yeah.
They issued that warning to loan servicers saying, hey, make sure you're telling their options and make sure they have options other than foreclosure, getting foreclosed on. So that kind of leads me to my question I have for you, because you're on the lending side. So let's say someone's been in forbearance for a year. Can they exit forbearance and then do a refi right away if they've been unemployed for a year? How does that all work?
Yeah, they're eligible to refinance right away. And forever, just like things have evolved and changed, and we thought that people had to pay the lump sum right away.
Yep.
When lenders were first kind of rolling out their rules around forbearance and refi, they said, we want you out of forbearance. We want you to make 3 consecutive payments. Then you're eligible. And most all lenders, as a wholesale broker, I've got 60 different lenders I can send loans to. And I feel like almost all of them, and most of the retail lenders, I think, are the same. Once you're out of forbearance, you're good and you can refinance. But you still
like
have
right
away. And it can be you've exited and you're due to pay your first payment on July 1st. And you just show that I'm not in forbearance anymore. And you can get something from the servicer. The caveat is you mentioned something about like unemployed for the last year. For anybody who has had employment changes, you're going to have to qualify. And for some people, it was, I was off for 2 months and they hired everybody back, and I've been back for X number of months, full-time, full pay. And, contact a local lender who you like and trust to give you real good guidance on that, because it's going to be different if you're commission, if you're salary, if you're hourly, if you're W-2'd, if you're self-employed, all of that, is kind of looked at differently by lenders. Ideally, you're W-2'd and you're full-time, full pay. And then, we can look past and get a letter of explanation for, I was out of work from April until June of 2020 because there was layoff of half the staff while they figured it out post-COVID or whatever happened there. But unfortunately, for a lot of people that I talked to, they missed a considerable amount of work and they took advantage of some of, state programs and unemployment. And, if they're back to work, but it's hourly, it's going to be near impossible to get any type of refinance, because hourly or commissions or anything like that, where it's going to vary from month to month and week to week, they're going to look at a 2-year history. And if you've got a big 9-month gap, your average over the last 2 years is going to be down quite a bit. So for those folks, they probably got to get back to work, have 6 months or 12 months under their belt, and then look at it then.
Interesting.
And I tell people too, if you don't qualify today, you might want to just check back in 6 months, because lending guidelines are ever evolving. And you've got that new program that came out, Refi Now, which
is it FHA program. Is that right?
That one's a Fannie to Fannie. So it's a conventional deal where they're trying to refinance people that didn't quite qualify.
Oh, right.
And so they're going up to 65% debt to income. I've talked to so many people though, Jason, and in practice, it feels to me like such a small sliver. In my experience, all the people I've talked to, they're either totally on the sidelines and out of work and collecting unemployment, getting zero, or they're, been working full-time, full pay, and they qualified. So they didn't need this program. Finding those people in the sweet spot where they make enough to qualify, but they don't make too much, because you got to be under the 80% average median income. Yeah. And I must have a dozen conversations, and it's like, okay, you're Fannie owned, and we verified through the lookup tool that you're Fannie to Fannie. So you're good there. You're under the 80% AMI, but you don't qualify because, not enough income to even get you below the 65% debt to income ratio.
Interesting.
And there's other people.
I wonder how many people actually know about that program too.
I don't feel like it's a lot. Yeah.
All the time. I barely know anything about that. I'm not a finance guy, but There has to be a lot of people that don't even know about that program.
Oh, I'm sure. I'm sure. I think it was the same too. Like back when when I was very first starting in 2013, there was the HARP, like Home Affordable Refinance Program,
Mm-hmm.
and similar, where it's like it's got to be a Fannie or Freddie, and I can't remember the exact rules back then, but yeah, just getting the word out to let people know was difficult. And then once you did get the word out, lots of people that didn't qualify were like,
Misinformation.
maybe I
Yeah.
qualify. Somebody told me this, somebody told me that.
Makes sense. Yeah, I agree. I mean, there's a lot of misinformation out there, is what I'm learning being on YouTube. I'm still kind of a newbie, I feel like, but um, there's a lot of misinformation out there. I think it's definitely our job to be act with integrity, unbiased opinion about, hey, what's really going on in the housing market right now, just so people can make more informed decision about whether they should buy
Right.
or sell
Yeah.
a house or refi. Right. With that said, I'm really curious to know about, you work with a lot of agents and real estate agents and buyers. Do you happen to know like the terms of the offers that you're seeing getting accepted? Do you know about the, what are you seeing in general about for people that getting offers accepted? Are they writing offers with no contingencies? Is it like $1 million over asking? What are you seeing on in your pipeline there? Because you work with a lot of agents and buyers, whereas I just have sellers and buyers. So you probably see a lot more of boots on the ground about what's going on right now.
Right. Yeah. And it's a fun seat where I'm at because I get to see different agents with different strategies and different styles.
Yeah,
And they're,
right.
they all have the same end goal. It's like, let's get this buyer in contract. And I would say that the most common thing I'm seeing between accept and not accept is, unfortunately for buyers who aren't in a position to remove the appraisal contingency, it
Mm-hmm.
almost feels like the price of admission right now,
Yeah,
where I've had buyers that were like, man, I said I'd pay at least 20,000 above ask. I can't believe I didn't get accepted. And I looked at it, and I try not to like overstep and step on the agent's toes,
sure.
where it's like the agent's going to advise on how to write the offer. But if you've got a really good agent, you're not going to know exactly what a house is going to appraise for. But if you're offering 530 and you're like, there's no way this thing appraises for less than 500. It probably appraises at 520. On a bad day, the appraiser might bring it in at 505, but like below 500, there's no chance. If you're willing to pay that 30K spread, it's just my opinion, and everybody's different. So, just waive the appraisal contingency altogether, because
Mm-hmm.
in a market as competitive as this one, the sellers just want certainty. And there's something about the appraisal not affecting the transaction that just gives the sellers some
Yep.
certainty. And
Yep.
so between that and having a strong buyer with a strong lender who reaches out and talks to list side, and this isn't a pitch for me because this is going to be good throughout the whole country. So it's not like it's just Matt, the mortgage guy, and him and his agents offers in California, but
Mm-hmm.
throughout the whole country. Like an article I read today on Inman talked about that, where if you've got a strong lender who's able to reach out to the list side and tell them, listen, I've got a full file. We've got the verification of employment. We've verified assets. They've got great credit. They've got 6-figure W-2 income. All that stuff just gives the seller certainty. And in a market where you're going to get 10, 12, 15 offers, you need to create some certainty, because a lot of these sellers, and you can attest to this, Jason, they're going to Idaho, they're going to Texas, they're going to Tennessee.
Mm-hmm.
They cannot afford to have somebody in contract for 3 weeks fall out. And
For
so
sure.
they want you to remove your contingencies as soon as possible, if you have any, so that they have certainty with, I'm trying to close on something in mid-July that's in Nashville, Tennessee, and this thing can't fall out. And so
Yep.
if you've got 14 offers and even the ones with the highest price don't offer the same amount of certainty, you might get your offer accepted slightly lower, saying, listen, the appraisal is not going to be an issue. We're going to buy it regardless, and we can make up any gap. So no appraisal contingency. Some people have talked about like waiving the inspection contingency, which I don't think is wise. And I really don't see it that much. And I see a lot of offers.
The offers you're seeing right now, you're not seeing a lot of buyers that are waiving the inspection.
No, the only
That's
time I
good.
see it is like they write some sort of verbiage where it's just like, we're not going to ask for repairs.
As is. Yeah.
We're not going to nitpick on repairs. They'll leave the inspection contingency in there, which I would as well if it's a 50-year-old house. If there's a $30,000 sewer issue, then I can back out, right? But I'm not going to
Mhm.
like ask you for like 2,000 in repairs because there's a little bit of dry rot or something that didn't even get called
Yeah,
in the appraisal. And so
sure.
the price is important. The local lender is important. And then the
Yes.
contingency periods, if you have a loan contingency, you want to shorten that because the seller just wants to be at a point after 10, 12, 14 days where like you've released contingencies and they're sure that you're
Yes.
going to close because they're going somewhere. They're buying somewhere else or they're using this money if they're an investor to go invest in something else. And
Or
so
renting. Yeah.
yeah, or doing something. And so that's what I'm seeing. And buyers should probably, part of this article talked about too, just being in the mindset that I'm probably going to pay somewhere between 7 to 10% above the listing price, and I'm
Mhm.
okay with that. And what I always try to encourage my clients to do is I'm going to give you all the information up front before you're even walking through an open house with Jason, before you've got your, realtor talking to you about like, we probably have to offer 535 in this place. You've already looked at scenarios. You know what 525 looks like. You know what 550 looks like. And you've played those scenarios in your head. You've messed with an Excel spreadsheet that I've sent you. And so when you walk through and your agent's like, they're like looking at offers tomorrow at 8:00, it's a short time to make a decision. And that's the kind of
Yes.
market we're in, but
Yes.
you're prepared. You're prepared before you even walk in the house that if I love this house and I know I have to offer 550, I know the monthly payment, I know the total cash to close. I'm prepared to do that if this is the one. And
Yep.
so that's like, I guess, a piece of advice for buyers is be well prepared to act swiftly, because even like me and you discussed, if it's a little bit softer, there's a little bit more inventory, the summer's not going to be as competitive as the spring, it's still competitive. And it's still going to
Very.
be a market where, most markets, you find a house that's looks nice, it's in a nice neighborhood, it's going to be attractive to other buyers, not just you.
Definitely true.
Yeah.
We were talking earlier before we hit the record button. Wrote an offer for a client for 90,000 over the asking price, all cash. Only had contingencies for inspections, and even though we wrote that offer, we were the lowest offer. And they had 7 offers on a $1.2 million house. Other houses we were interested in, one had 15 offers, the other had 7 offers. And then one of them, I think 2 of them accepted offers with no contingencies whatsoever. And my last 2 listings I've had, we accepted offers with no contingencies whatsoever. So yeah, I mean, one of them was like going to be like a tear down or a big remodel. So maybe inspections don't really matter so much. The other one, newer house, right? It's like, I think it was like only 8 years old, super clean. So, on a slab foundation. So what are the chances you're going to have major issues during the inspections? But yeah, it depends on, you have to be, I guess the point I'm trying to make, you have to be aggressive on writing your offers. You can't go in thinking, oh, I'm going to be looking for a house right now, get a great deal under the asking price. It's more than likely probably not going to happen. You have the different mindset with, there's a lot of other buyers who are probably gonna be interested in the same house I'm interested in, and I got to go in strong. And I 100% agree with you. Working with a trusted local loan officer, that definitely helps. I mean, if you have all other things being equal, same offer amount, same contingency periods, and you have, I don't know, Quicken or whatever, some online lender versus a local lender, the listing agent's going to be pushing for the local loan officer for sure, because everyone knows that it's a little more challenging to get offers accepted when someone uses an online lender, for example.
Right. Yeah. There's a level of certainty, and they just know that throughout the transaction, they're going to be communicated with. Somebody local's got a reputation to protect. And,
Yeah, right.
if I call you beforehand and say, oh, it's going to be a smooth and easy deal, get it closed in 25 days, you rest assured, me and my team are going to answer the phone. We're going to give you updates throughout the process and do our best to close it on time without any issues, so that we protect that reputation we've worked so hard to get. So,
Definitely true.
yeah. What surprised me a lot as you were
What's
talking
that?
about that like $1.2 million price point is, I remember a few years ago where you could segment the market and say like from 250
I know where you're
to
going with this. This is
yeah,
good.
250 to 500,
Yeah.
it's super competitive. And then 500 to 750, a little bit less. And then above $1 million, there's only so many people that can qualify. You're not going to have as much competition. It probably speaks to, like, some people talk about the K-shaped recovery, where, during COVID, a lot of people that were, in the restaurant business or other areas got hit really hard and impacted. Some people that were well off became more well off. And so they've, not, they've thrived through the pandemic. And so
Absolutely.
there's a lot of money at the top. And so it surprises me that those markets are as competitive and sometimes even more competitive than the entry level markets, where we used to see the most competition because the most people qualify to buy something at the entry level. Now, bidding wars and 14 offers for something that's $1.25 million is wild, especially for, me and you are both in the Sacramento market. And so the median is not anywhere near where it is in the Bay Area, but we've got some migration and we've got some people that are successful in Sacramento and surrounding that are able to offer 100,000 above ask at those million plus price points.
No, it's sad but true. The K-shaped recovery is definitely something we're seeing. I mean, you think of a renter who is a busser or waits at tables. They got laid off, and there was really little assistance. There's no forbearance at that time for renters back in March of 2020. And then you have someone else who is a homeowner who now has their home is now worth like 20% more than it was before 1 year ago. In the meantime, they also could do forbearance for 12 to 18 months. And then on top of that, they're able to get PPP funds, for example. And if they had funds to invest in the stock market 1 year ago, then the stock market's bananas. So yeah, it just really goes to show how the people who had the funds and have not been affected by this pandemic as much are just way ahead. These other folks have it true.
Yep. And then they try to help out by these programs like this Refi Now program. And then there's going to be a Freddie Mac version of that same refinance program coming out. But I don't think, like you said, I mean, people don't even know about it. And then those that do, there's going to be a small sliver of them that qualify. But the whole point of those programs was people that are well-to-do, who probably don't need it as much, able to refinance their mortgages into 2.625 and 2.75. And so they're saving hundreds of dollars a month and they probably don't need it. That extra money is going to go into Robinhood or Fidelity, their stock account. Whereas the people that like that $200 a month is going to mean a lot. They've got to figure out how to get kids back in childcare and get back to work. Those are the people that these programs are meant to help out. I just don't know how many of them are going to actually fit in the bucket that they've created for those programs.
Yeah, absolutely. And then in the meantime, inflation is just rampant. And so the people that can bear, they're scraping by, they're going to the grocery store and finding that everything's much more expensive too. So, but true.
Yeah.
All right, let's talk about interest rates. So right now, interest rates are around like 3.15 ish.
Yeah, probably around the 3% mark for the well qualified. And we had come down below 3%. We hung out under 3% for a little bit, and then last Wednesday, the Fed talking about raising rates, and so that had an effect on mortgage-backed securities, and we saw a little tick up. But right, 3% ish is a good ballpark for the very best of the scenarios without paying any points. And then, as your credit is lower, or maybe you're putting 3% down or other factors that, take a hit to that rate, then we're, 3.25 to 3.5.
Makes sense. And so what do you see rates doing the rest of the year? Any predictions or any thoughts about that?
Yeah. I mean, I've felt this uneasiness around rates for the last couple months, and I've voiced it to, my past client database and on other, podcast interviews that I've done, where eventually the Fed is going to take their foot off the gas. And like just them talking about it last week, where they said, instead of 2024 for raising the Fed funds rate, maybe it's 2023. Just that talk had rates creep up an eighth or whatever it was. When they actually start,
right?
When they actually start doing it, though, and the Fed funds rate goes to 1/4 to 1/2 to 3/4, like I did a video where I showed the graph where it's not like the Fed's funds rate and the 30-year mortgage interest rate are different things. So they're not going to track equally, but they are correlated over the long term. So like the Fed funds rate goes to 1 18 months from now, rates are going to follow. And another like cool thing that I was listening to somebody where historically the 30-year fixed rate is about 2% higher than the 10-year treasury. The 10-year treasury is at about 1.5 right now. And rates are closer to 3. So there's only about a 1.5 point spread right now. they were
Mm-hmm.
talking about how there's going to be a return to normalcy in that spread to where, you know, a 2% difference between the 10-year and the 30-year fixed rate mortgages. And if the 10-year goes to 2% and that 2% spread comes back, then we've got
Decreases, yeah.
4% 30-year fixed. You know, if I were to guess and someone asked me like end of December 2021, where do you see the 30-year fixed? I probably would say, if I was given like quarter like buckets to put in, between 3.5 and 3.75. So about 0.5% higher than we are now, just because after the last meeting where, you know, they've got people doing the dot plots and when are we going to move it up? And some people said 24, some people moved it to 23. It was Bullard or somebody on the Fed who said they think 2022. So it's inching closer and closer. And we realize the Fed can't forever suppress interest rates. And so eventually they're going to have to take their foot off the gas and see what happens. And some people are even thinking it's detrimental to keep rates suppressed as long as they have, and that they should be acting sooner. Yeah.
I mean, in my opinion, they should, you know, do it earlier, because the inflation just super high right now, and then also the housing market needs something
Right.
to slow it down. It's not healthy market whatsoever. And so if the Fed were to increase the federal funds rate, as you say, it's loosely tied to mortgage interest rates, then one would assume that rates would increase, and that potentially could lower demand. I was thinking about this the other day, because mortgage rates increased quite a bit. What was it, in late 2018, if I'm not mistaken?
Yep.
Got up to, what was it, 5%? Is that right?
Yeah, it was probably pretty close. Yeah.
Yeah. So then we saw the housing market actually slow down a bit, not crash, but at least it slowed down. And so, yeah, it's going to be interesting to see what happens with rates. And I kind of agree with you. I was thinking more of like around 3.5%, based on no knowledge about what happens on the back end of that whatsoever. But also in my opinion too, like I think that people are super used to having rates around 3%. What did they increase to earlier this year? 3.75, something like that, 4%?
Yeah, I mean, it varied by lender and it varied, you know, the scenarios, but they got up to, you know, 3.5 to 3.75. If you had, you know, challenge credit, maybe it was 4%. So they're about a half point higher than they are now. But yeah, I agree with you. Like, let's just tick it up a quarter and see what happens. You know, pump the brakes a few times to slow this train down. And I think it will be a healthy thing, especially considering, like, if you just keep barreling forward at 150 miles an hour, like, it's going to be more of a jerk reaction when we have to pull the emergency brake, versus like, we're going downhill. Let's pump the brakes so we don't get this thing going too fast, or we're going to be going so fast that in 2023, when you finally pull the emergency brake, somebody's head's going to hit the windshield.
Yeah, it's a good analogy. I think all of us would really appreciate some sort of a normalcy in our housing market, right? It's about time.
Yep.
Anything you want to add about, you know, what you're seeing on the lending side, that maybe people who are shopping for houses or thinking about shopping for houses, or even selling a house, that you want to educate people about?
Well, one thing I'll mention, because I talk about it on a weekly show that I'm on, where, you know, I get to see inside the belly of the beast. So, you know, I'm talking about every day dealing with, you know, mortgage clients and real estate agents versus any data. Mortgage lending is slowly getting stricter. And I can give you a really specific case where it used to be, we'd look at a number of different deals and you might say, this person's got a 712 credit score, and their front end ratio, meaning just the mortgage versus their income, is 35%. And then their back end ratio, which is their mortgage plus all their debts versus their income, is 44.
And we used to income ratios.
Yeah. We used to look at that debt to income ratio and be like, okay, they're fine. You know, 712. And you plug it into the automated system. And some people don't know that, you know, in order to actually get a loan to the finish line, it's not just like you submit to the underwriter says, it looks pretty good. The automated system has to give you an approve eligible. And so we were getting approve eligibles on scenarios like that as recent as 3 months ago. And now I'm plugging some stuff in and I'm saying, wow, like that 3% down, 712 credit score, 35 over 44, it's approve ineligible. And then, you know, we can kind of put in different things and massage the loan, we call it in my office, to see, okay, if this person puts 5% down, does the system like it then? If this person pays off some debt and that back end goes to 41, does it like it now? And before, it would be like, okay, maybe this person's got some old derogatory on their credit report, and it's like the system doesn't like it because of that, or it's a 3% down, so the system's saying not enough skin in the game. And so I was seeing like this ever so slight tightening. And recently, like last week, I had a specific buyer that was approve eligible a month ago. Once we got back the verification of employment that really dialed in their income, same ratios, same buyer that was approve eligible, all of a sudden approve ineligible. And that tells me it's not like, one buyer A versus buyer V and buyer B has a different profile. It's the same exact, and so that's like proof that Fannie and Freddie are tightening, albeit ever so slightly maybe, but for buyers who are maybe on that cusp of like, hey, as a first time buyer, the neighborhood I want to buy in, it's about 425. If I would hate to see somebody get completely like priced out of the market, where if rates went to 3.5 and those ratios got a little bit higher and they just don't qualify anymore, they just cannot buy a house like that. That would be bad, because I really feel for, more than anybody, those first time home buyers that are like, I've entered the workforce, I've worked on my credit, I've got it up to a 720. I'm just starting out, so I don't make a ton, but I make enough where I think I qualified to buy something that's, 2-bedroom, 1-bath, and it's going to be my house for the next 5 or 7 years, and it's in a decent neighborhood, and I can get that for the low 400s. For those people to be in a position where a month from now, 3 months from now, 6 months from now, because of a little bit of lending tightening, aren't able to qualify at all, would be sad. So if you're thinking about buying, please don't wait and then be in a position where homes are more expensive, lending's more tight, and rates might be 0.5% higher at the end of the year. If you're, if you, and that's the thing too, is like, I never am a salesperson that tells people you got to buy a home. It's the American dream or whatever I would sell. Right. If it's not
best time to buy is now.
Right. Yeah. So it's not the time to buy for you, so be it. But if you do qualify and you do want to buy, get all your stuff together, get with a great agent and a great lending partner, and go out there and submit offers and get yourself into a home. Because, I tell the story to a lot of people about the house I bought in 2006, because people are like, what if I buy it here, then it's worth here? If you get into a 30-year fixed rate mortgage on a house that you plan on holding for a long time, I bought for $345, and people don't realize what great rates we have nowadays. But in 06, it was a 6.75 first and a 12% second. Wow. So I was paying $2,700 between the first and the second for a $345,000 house.
Yeah.
And it was 3 short years later where, the wheels fell off and everything around me was selling for $180,000. And if I was in a 30-year fixed rate mortgage at a 3% rate, I could have weathered the storm a lot easier. As it is, I did weather the storm. I still own the house. $550-ish is what it's worth. I've got tenants that pay the mortgage. And so like my net worth just increases every year from appreciation and debt pay down and all that other stuff.
Yep.
I wouldn't undo that house I bought in 06. If you're going to hold real estate long-term, it's very often going to be something, that's a bad investment if you hold it for 20 or 30 years, right? Real estate just goes up over time and long time horizons. So
payment remains the same if you don't refinance.
Right. And that's the key about today, is like, you might pay more and be afraid that it's like, oh my gosh, $525,000. If it's an affordable payment and you have some security in your job, like that payment's not changing. And more than likely, most folks have some trajectory on their income and on their career path, where 5 years from now, 10 years from now, if your payment is 30% of your income right now, and your income goes up by 30% in the next 5 years or the next 7 years, then that mortgage payment relatively becomes smaller. And the homeowners who bought in 2012, who have an $1,100 mortgage payment, feel pretty good in markets where rent is $2,500 a month. So
or they can sell and they have so much equity in their house and buy something different, right?
Right. Yeah. Go buy cash in Tennessee. So I guess that's my long-winded thesis on why I'm still bullish on real estate. I believe
Yeah.
in real estate. I'm not going to try to sell you anything. Lucky for me, I'm so busy that I don't need to, talk anybody into doing anything. I just provide advice and education. And if it's your time to buy, great. If not, no big deal. But no matter where folks are in the country, I'd love for them to check out Matt the Mortgage Guy on YouTube. I think there's some stuff on there that might help them understand mortgage a little bit better. And no matter what market they're in, there's good information on, how mortgage works and what things they should be asking and things of that nature.
Yeah, you have a great channel, and congrats on you're approaching 10,000 subscribers now. It's awesome. And you seem to have a similar approach to my channel too, just providing the information so people can make a more informed decision.
Right.
Simple as that, right? And being transparent. So yeah, anyone watching right now who's not subscribed to Mac the Mortgage Guy, please do. Anything else you want to say to wrap it up?
No, I appreciate you having me on, man. I've been watching your stuff, following your stuff. I love all the data you put out and all the figures. So I'm looking forward. What can I expect from you? You said tomorrow's NAR's data coming out.
So tomorrow, the 22nd, is when the National Association of Realtors posts May's existing home sales. Cool. And again, records being broken October 2020, March, April. Let's see if it gets broken in May. It did in California, just by a smudge. So yeah, I'll be making a video next couple of days. So stay tuned for that. But yeah, Matt, really appreciate you joining us today. Really appreciate your insight. I love your channel. And so yeah, anyone watching this video, if you got any value out of it, then please hit the like button, and we'll see you on the next video.